Welcome to our indoor expertise and serious discussion on where to keep the money saved to make it grow. This topic is fluid and offers a variety of methods, each with its unique pros and cons. Starting with the basic understanding of saving and growing money, we will venture into topics such as savings accounts, certificates of deposit, money market accounts, stocks, and real estate investment. We will carefully thread this journey, providing a comprehensive view of these options. A savings account is the perfect starting point for those who want a safe and liquid option for their savings. It's generally a low-risk, low-return method but is insured by the Federal Deposit Insurance Corporation, FDIC, or the National Credit Union Share Insurance Fund, NCUSF, guaranteeing the funds of every account holder. With the convenience of easy access to funds, a savings account is suitable for financial emergencies and short-term financial goals. If you're looking for a more secure and higher interest option, then the world of certificates of deposit, CDs, may appeal to you. Certificates of deposit are time-fixed deposit products offered by financial institutions. They often provide a higher interest rate than savings accounts and can earn even more from those with longer terms. However, CDs do have a penalty for early withdrawal, so they may be best suited for funds that won't be needed in the short run. A money market account is like a hybrid of a savings account and a CD. It provides a higher interest rate than a regular savings account and gives you a lot of flexibility with your cash. It is important to understand that many money market accounts come with a high minimum balance requirement. But if you can meet the requirement and would like the option of writing checks against your account, a money market account may be a choice for you. For those with a higher risk tolerance and a long time horizon, the stock market can be a compelling choice. Although it comes with volatile and unpredictable market movements, prudent investment in solid companies or index funds could bring in considerable returns over time. Stock market investment can be significantly rewarding, but it demands a keen understanding of market trends, economic indicators, and company performance. Real estate investment is a tangible asset that makes it an appealing option for growing the money saved. Over time, not only can property values rise, but you can also collect rental income. However, real estate investment comes with unique challenges, including significant initial costs, landlord responsibilities, and potential market downturns. The various choices we have discussed come packaging themselves with a level of risk and return. The decision on where to keep your money to make it grow is a personal one and depends on your financial situation, goals, and the level of risk you are willing to undertake. Each option has its pros and cons, and we will explore them. A savings account guarantees your principal and is perfect for short-term goals and an emergency fund. Certificates of deposit offer a higher rate of interest with security, while money market accounts provide liquidity and a potentially higher rate of interest than regular savings. The stock market and real estate investment opportunities have higher potential returns, but the risk is higher too. Weighing these factors, we will establish a journey line adorning the concept of making the money saved to grow. Let us take you to the journey of the stock market. It's a place where companies are listed and traded publicly. As we have learned, stock market investing can be risky, but it can also be rewarding. It is crucial to understand that the stock market can be volatile. Even the strongest companies can see fluctuations in their stock prices, created by business cycles and changes in industry conditions. As a future investor, you should first ascertain whether you have current financial obligations, such as a mortgage or student loans. If you're financing high-interest rate credit card debt, it doesn't make sense to invest in the stock market until you've settled these debts. The interest rate on credit card debt is a guaranteed expense, whereas the potential return in the stock market is uncertain. Another aspect to keep in mind is the need for immediate liquidity. Stock market investments should usually be viewed as a long-term commitment, ideally a minimum of 5 years and preferably even longer. You should have a separate emergency fund in place, perhaps in a savings account, that will allow you to access cash for unexpected expenses and reduce the temptation to sell your investments, particularly if the stock market is performing poorly. Comfort with risk is another determinant. Stock market investing involves risk, and the value of your investments can fluctuate widely. Being comfortable with this level of risk and not panicking when the market is down is critical. If you'll need the money in the short term and can't afford the declines in the stock market, then it's best to steer away from stock market investing for now. With clear information and an understanding of your current financial situation, you can start investing small amounts that you can afford to lose, progressively building as your knowledge and capacity grow. Diversification is key. Don't place all your bets on one company or industry. Purchasing shares in multiple companies and across various sectors makes it possible to lower investment risk. The stock market offers a wealth of financial opportunities. The key is to start small, understand the markets and companies you are interested in, and always work to diversify your portfolio. Keep in mind that you are a partowner in a company when buying stocks. As partowner, you get access to a share of the profits, determined by the company's board of directors and distributed as dividends on a regular basis. This translates to a steady income stream in the long run. The stock market can be overwhelming at first, and understanding the risks and rewards associated with it is important before making any investment decisions. Only invest money you can afford to lose. Over time, an investment in a broad portfolio of stocks can be rewarding, offering market-like returns and grow the money saved to surprising levels. While the stock market involves direct equity and mutual funds, we will shed some light on real estate investment. Pieces of land and buildings, tangible assets that have intrinsic value, make real estate an attractive investment. In addition to potential for capital appreciation, real estate also presents rental income, offering returns in the form of passive income. Real estate serves a hedge against rising inflation. When consumer prices increase, so do rents and the value of your property, offering a safer investment bet. Also, real estate affords several tax benefits. Your insurance premiums, agents' fees, maintenance costs, and the interest on any loans can be deducted from your rental income. However, real estate is a local business, and current environmental trends play a bigger role in influencing the markets more than any other factor. It is vital to meticulously research different locations and studying the local market conditions to make informed decisions. Also, the initial costs of acquisition are substantial, comprising of down payment, financing costs, legal fees, taxes, and repairs. Furthermore, real estate entails active management, meaning you need to stay informed about the markets, fielding tenant calls, managing property upkeep, and possibly dealing with disputes. Therefore, if you're looking for a passive investment where you don't have to do anything, real estate may not be for you. Investment properties have to be maintained and tenants need to be managed. Nevertheless, owning and managing a successful rental property can be both profitable and satisfying. The combination of rental income and potential property appreciation can provide a strong overall return. The more effort you put into securing a valuable property and responsible tenants, the more benefit you'll reap from your real estate investment. Real estate investment trusts, REITs, is an opportunity, allowing you to invest in a diversified real estate portfolio. Think of it as mutual funds for buildings and mortgage loans. REITs offer the following benefits: regular income, potential for long-term capital appreciation, and a hedge against inflation. REITs also provide market liquidity as they are publicly traded on exchange. Like stock market investments, real estate investing has associated risks. The value of REITs is subject to market fluctuations. Some of the other concerns with real estate investing include illiquidity and lack of diversification. Nevertheless, a cautious approach to real estate investing, thorough market research, and a long-term investment horizon will help in making the most out of it. Besides understanding the risks and rewards, having a plan is imperative. Having a defined investment goal, time horizon, and risk tolerance can influence the decision-making process when choosing where to put your money. The power of compounding wealth should be no stranger to you. The longer you stay invested, the greater the growth potential of your investment. Remember to continuously review and adjust your investment strategy. Changing economic dynamics, individual lifestyle changes, and unforeseen expenses can make the plan less efficient. So, it's key to periodically review and make alterations as needed to keep moving towards your intended financial objectives. Regardless of what investment vehicle you pick, early planning and consistent contributions will surely make a difference. The key to growing your money is to understand your options, weigh the benefits, and embrace the necessary risks. Financial awareness, patience, and discipline will put you on the path to growing the money saved, reaching your financial goals, and securing your future. The choice of investment avenue is influenced by a variety of factors, including your financial situation, personal preferences, and long-term financial objectives. Determining where to keep the money saved to make it grow is a monumental task and requires weighing the advantages and risks associated to each investment prospect. History has shown us a multitude of paths to wealth creation, and success is driven by the discipline to stay the course and the understanding to avoid common pitfalls. At the end of the day, growing your savings is a personal decision requiring consideration of your current circumstances and your future objectives. Go out and explore the varied options available to invest. Avoid the temptation of trying to time the market, and remember, patience and perseverance are your best friends in financial planning. We hope this journey to understanding where to keep the money saved to make it grow has been beneficial. Remember that these are just a few out of the several investment vehicles available. Every individual and their investment needs are unique. The choice of investment vehicle is influenced by a variety of factors, including your financial situation, personal preferences, and long-term financial objectives. As a wise investor, you are constantly learning and improving your knowledge. The importance of staying up to date with the latest market trends, economic news, and individual company performance can't be overstated. Continuous learning enables you to make informed investment decisions and optimizes your investment returns. So, invest wisely, keep learning and growing, and remember, the journey of 1,000 miles begins with a single step. Don't get overwhelmed by all the different options available. Instead, start with what you are familiar with, and as your portfolio grows and your comfort level increases, you can begin to explore different opportunities. What matters most is starting, sticking to a plan, and regularly reviewing and adjusting your portfolio. Investing rewards players who adhere to disciplined approaches, maintaining a long-term focus, constantly making small contributions, and continuously improving knowledge while avoiding emotional and impulsive decisions that may disrupt the investment journey. Remember, when it comes to investing, there are no shortcuts. We hope you've gotten some great insights from this video on where to keep the money safe to make it grow, and that you're now more comfortable with the idea of growing the dollars you save, allowing them to buy back time for you. Keep in mind, investing in human capital is the best investment, and it's never too late to start. So, start today.